Man, on a brutal day, we're trying to get our heads around the terrible action. But here's the question. Have the oil refiners come down enough to be attractive here, or could the group have even more downside if the recent breakdown in crude? Consider the case of Marathon Petroleum, the best-run refiner in America, with a nice catalyst in the form of this acquisition of Endeavor, which closed on October 1st. Yet as oil prices have plunged, Marathon stock has been crushed, down more than 20% since the beginning of the fourth quarter. Is that right? Now, refining is a margins game. Over the long haul, these companies can thrive in an environment with lower oil prices, but in the short term, major dislocations can do some damage. That said, we got some very good news today. Marathon's Investor Day, they told us that they now expect $1.4 billion in annual synergies from this combination with Endeavor, up from $1 billion originally. I thought that was astonishing. So should we view the recent weakness in the stock as a buying opportunity? Let's dig deeper with Gary Heminger. He's the chairman and CEO of Marathon Petroleum, straight shooter, here with us. Give us the insights that the professionals got at his annual Investor Day. Mr. Heminger, welcome back to Mad Money. Good to see you, Gary. Good to see you. Have a seat.
Thank you.
All right, first of all, I want people to understand that when you put these two companies together, there is just remarkable amount of savings, and you're incenting people to make it so there's even more.
We are, Jim, and we set up a synergy incentive program, and as you stated just a second ago, we believe we have the potential up to $1.4 billion of synergy, but in order to be able to capture that, we need everybody involved, not just the executive management team, but everybody in the company. So the entire incentive compensation program, this is going to be one of the largest metrics. So everybody in our company will be part of this program going forward.
Well, there is a belief that I think you can express maybe incorrectly, that as oil prices go down, Marathon Pete should go down with it.
That's always, that is frustrating that you see the markets move, because anytime oil goes down, that's cost of goods sold. And if your costs are going down, that should help margins in the short term and maybe even on the longer term. And we're seeing that in the marketplace today. But the market still, I don't think, recognizes how those two fit together.
Well, let's use an example, because you're everywhere. Permian Basin. Now, they can't get the price that we see for West Texas. Canada can. Now, that doesn't necessarily they can get hurt by them, but you might be the big winner in that.
Well, we have tremendous, you look at Canada, the Western Canadian Select, and we have tremendous pipeline space to bring that crude into our Mid-Con, and we even take it down to our Garyville and Galveston Bay refineries. So we can capture some of those discounts on that margin. The same thing from the Permian. And as you know, we're looking at some new big pipelines to take that Permian crude all the way to our Galveston Bay refinery and down to the Western Texas export facilities.
Now, you have a lot of different places. You have a Mexican strategy, but you also a gigantic convenience store group that people should like.
We do. With this combination of Speedway and taking over the Endeavor sites, we'll now have 4,000 Speedways coast to coast. And we're going to sell, through Speedway and through our Marathon brand, about 16 billion gallons per year. So we're going to have tremendous exposure all the way to the consumer. And that's where we really believe our integrated model will make a difference in the marketplace.
Couldn't agree more. Now, you have a 2019 business plan where you say West Texas Intermediate $64. One, how did you arrive at that? And two, what do the OPEC meetings mean to that price?
Well, when we looked at West Texas Intermediate and looked at our whole forecast for the coming year of 2019, we look at many different forecasts and many different models. But we really believe, the price is probably going to end up being somewhere $65 to $70 in 2019 on an average. I believe we've averaged almost $65, about $64.50 year to date in 2018. So we think we're being conservative looking at that number for next year.
So you think this price right now is an aberration, this lower price?
I think the price will come up because I do, to your second part of your question on OPEC, with a meeting coming up later this week, I do expect that we're going to see a pullback in OPEC production. If that's the case, we'll see crude prices inch up.
Okay. Now, wealthy individuals, and I think everyone should accrue to them, but wealthy individuals love master limited partnerships. You have, I think, maybe the finest one, MPLS, yield 7.4%. People tell me there must be something wrong. Maybe there's something wrong with pipes, something going on in America that makes it so that's not sustainable. But you know better than anyone whether there's coverage for that.
Well, you're right, Jim, and this is a company. You're right, 7.5% yield or so today, and we have one of the best growth profiles in all of the MLPs. So, as we laid out in the investor program today, we expect around a 5 to 6% increase in our distributions next year. But if we don't see that we're getting paid for that, I think the best thing to do is to possibly buy back some of those units instead of trying to, we're not going to chase the market and chase the yield. If we don't get the yield for our performance, then we'll just buy back some of the
That's highly unusual, but very positive, bro. Shareholder, let me ask one other thing. We've had tremendous market volatility. I've always felt that the key to combating that is to have a consistent dividend policy that makes it so that you buy more when it goes down. Your company is addicted to giving money back, isn't it?
Well, we've had a very strong run in, if you look at our total cash flow yield, we've had a 10% return to shareholders, twice the S&P 500, more than twice our industry peers. We've had a compounded growth rate in our dividend of over 26%. I expect that the board, when we look at this in January, that we'll take another look at our dividend. But as far as capital return to shareholders, we've bought back we'll buy back here in the fourth quarter about $700 million, and we expect to buy back about another $2.5 billion of shares in 2019.
Again, very unusual. We have to recognize that there used to be just these are big commodity plays. It's no longer that way because you're more specialized. Do you think the president helps or hurts oil when he says bad things about OPEC, and given the fact that Russia is not part of OPEC but they're involved, can that backfire? And why hasn't the president done more to make it so that FERC is more friendly on a regulatory basis to putting out more pipes, given the fact that's been one of his themes? Instead, he seems to focus on coal so much.
Well, the president has been very strong in supporting our industry. Right. When you look at permits for pipelines, he was the first to come out, and the presidential order to approve the Keystone Pipeline. Now it's been held up in by a federal judge. But when I look at the president's theme to begin with, in the beginning of his administration, it was he wanted to have energy dominance in the U.S.
Right.
And I believe that we are well on our way. We're the largest producer in the world today in America. Our refining system, I think, is second to none. The U.S. refining system, second to none of anyone in the industry. So I believe we're well on our way. Now, I also believe we should still have some relaxation of some of these standards, the renewable fuel standard, the CAFE standard that's being discussed. I think hurt the overall light products market. And I believe that we'll see probably some improvements in those standards going forward.
Excellent. Well, you have always been incredibly shareholder friendly. The MLP, too. It's just an amazing story. Congratulations on putting these two together. It was really smart.
Thank you.
That's Gary Hemingers, this chairman and CEO of Marathon Pete. It's been the one I've been recommending for years. I feel even more strongly about it since the Endeavor deal. And by the way, again, the MPLX, that's a very good yield, and I believe a safe yield. Mad Money's back after the break. Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.